Singapore's STI ETF just hit record highs. But wait, is this the worst time to buy, or the best chance to build lifelong dividend income? Because here's the truth. Most people get scared right when compounding is about to reward them. So today, we'll break it down once and for all. Is the STI ETF still worth DCAing into at $4.47? Is it expensive or cheap? And how does the coming Fed rate cut affect Singapore dividend investors like you? Stay with me till the end, because I'll show you real numbers, PE, PB, and yields, so you can make smarter, calmer decisions as a Singapore income investor. And before we start, smash that like button so more Singaporeans can watch this and learn how to become cash flow rich, not paper rich. Today's video was actually requested by a viewer. Shout out to Mike, who said, "Please share a video. Is it still a good time to DCA into STI ETF at this all-time high price? I've already accumulated 11 lots." Mike, this one's for you, and for every Singaporean wondering if it's too late to keep investing when prices look high. And as always, all financial data in this video comes directly from the official website of State Street Global Advisors Singapore Limited, the fund manager of the SPDR Straits Times Index ETF, code ES3. Disclaimer: this video is for educational and informational purposes only and does not constitute financial advice. Always do your own due diligence and consult a licensed financial advisor before investing. Chapter 1. What is dividend investing? Dividend investing is simple. You're not chasing stock prices, you're collecting steady cash flow. Instead of hoping a stock goes up, you're focusing on companies that pay you regular dividends, like collecting rental income, but without the property headaches. And a dividend ETF bundles many dividend-paying companies together. You get instant diversification, consistent payouts, and peace of mind, especially if you're building passive income for retirement. Chapter 2. What is the STI ETF? The SPDR Straits Times Index ETF, ticker ES3, tracks the performance of the Straits Times Index, Singapore's main stock market benchmark. It includes 30 of Singapore's biggest and most stable companies: banks, telcos, REITs, and industrials. Here are the top 10 holdings as of the latest fact sheet, August 2025. 1. DBS Group, 25.47%. 2. OCBC, 13.61%. 3. UOB, 10.88%. 4. Singtel, 7.73%. 5. Jardine Matheson, 3.84%. 6. SGX, 3.36%. 7. CapitaLand Integrated Commercial Trust, 3.25%. 8. Keppel Limited, 3.08%. 9. ST Engineering, 2.87%. 10. CapitaLand Ascendus REIT, 2.42%. Together, these 10 already make up more than 75% of the STI ETF. So, you're basically owning the heartbeat of the Singapore economy. That's why, for beginners, the STI ETF is often the easiest and safest way to start investing in Singapore stocks. One click, instant diversification, and you start receiving dividends twice a year. Chapter 3. From 2002 to today. Let's take a step back. The STI ETF has been around since 2002. That's over 2 decades of Singapore's financial history. And this ETF has quietly lived through everything. It saw the dot-com crash. It endured the global financial crisis. It stayed standing during COVID. And it's now riding a comeback led by Singapore's banks, REITs, and blue-chip giants. If you had invested 10,000 Singapore dollars at the start and simply held on, reinvesting your dividends, your money would have grown at roughly 7.5% per year on average. Not spectacular in headlines, but remarkable in reliability. Through every crash and every recovery, one pattern keeps repeating. Those who panicked and sold walked away with regret, while those who stayed invested and collected dividends saw their wealth quietly compound in the background. That's the beauty of dividend investing. Your returns don't depend on daily price drama. They depend on time, patience, and discipline. When Singapore sleeps, your dividends are still working. Chapter 4. Is the STI ETF expensive or cheap now? Fast forward to the 3rd of October 2025. The STI ETF, ticker ES3, closed at $4.47 per unit, which is actually near its all-time high. Now, let's look under the hood, straight from the State Street Global Advisors Singapore Limited fact sheet. The assets under management are about 2.19 billion Singapore dollars. The price-to-earnings ratio stands at 13.7 times, while the price-to-book ratio is 1.46 times. The distribution yield? That's about 4%. So, what does all that tell us? Well, it's not screaming cheap, but it's not expensive either. Historically, the STI has traded around a PE of 12 to 15 times and a PB near 1.4, which means today's level sits right in its fair value zone. In plain English, this isn't a frothy bubble. It's a stable, income-producing vehicle with strong fundamentals, anchored by Singapore's biggest banks and REITs. And that 4% dividend yield is no small deal. In a world where savings rates may fall again after Fed cuts, a 4% yield backed by real businesses looks like a comforting cushion for income investors. So no, the STI ETF isn't cheap, but it's steady, dependable, and still rewarding those who value cash flow over speculation. Because for Singapore income investors, fair value is good enough, as long as the cash flow keeps coming. Chapter 5. Your paycheck while you sleep. Here's something many new investors overlook. Your real returns from the STI ETF don't just come from price growth. They come from the steady heartbeat of dividends. At the latest closing price of $4.47 on the 3rd of October 2025, the trailing 12-month dividend yield stands around 4%, and the forward yield, based on upcoming corporate payouts, is expected to hover between 4.1 to 4.3%. Let's put that into real money. If you invest 10,000 Singapore dollars, you're likely to receive around $400 a year in dividends, without having to lift a finger. And if you reinvest those payouts, they start compounding on their own. That's what I like to call the Singaporean snowball. It may start small, but every year your dividends buy more units, and every new unit pays you more dividends. It's not flashy, it's not viral, but it's reliable. And that's what most of us need to achieve financial freedom: steady, predictable, cash flow-rich income that grows quietly in the background. Chapter 6. The benefits and risks of owning the STI ETF. Let's be real. No investment is perfect. The STI ETF comes with many strengths, but also a few risks you should know before you invest. The benefits. Diversification made easy. With one purchase, you instantly own a slice of 30 blue-chip Singapore companies, from DBS and UOB to Singtel and CapitaLand. You get a steady income stream. Dividends are paid twice a year, and you don't need to pick stocks because the ETF automatically mirrors the index. There are low fees and a transparent structure, managed by State Street Global Advisors Singapore Limited, one of the world's largest ETF managers. CPF investment scheme eligible. You can even use your CPF OA to invest, which means your money is working harder for you. And it's perfect for beginners. You don't need to study balance sheets or time the market. Just invest regularly and let Singapore's best companies do the work for you. But here's the other side of the coin: the risks. The STI is heavily concentrated in banks and REITs. If interest rates rise sharply or the property sector slows, your portfolio can be affected. Market volatility is real. Prices can drop during recessions or global sell-offs. Dividend cuts can happen if companies face earnings pressure. Remember 2020? And finally, long-term patience is key. This is not a get-rich-quick product. It's a build wealth slowly machine. Think of it like owning a mini Singapore in your portfolio. When Singapore thrives, you thrive too. You collect income from banks, malls, telcos, and industrials. The same pillars that make our economy tick. But just like the real economy, it can go through storms and slowdowns. That's why your secret weapon is time and discipline, not luck or timing. Chapter 7. DCA and the Long-Term Investor's Mindset. Now, let's talk about one of the smartest and most stress-free strategies ever invented. Dollar cost averaging, or simply DCA. Here's how it works. Instead of trying to guess when the market will rise or fall, you invest a fixed amount every month, rain or shine. When prices dip, you automatically buy more units. When prices rise, you buy fewer. Over time, your average cost smooths out, like how a disciplined saver builds wealth through consistency, not luck. Think of it like planting seeds in your garden. You don't dig them up every week to see if they're growing. You water them regularly, and you trust that, with enough time and sunshine, your garden will bloom. That's the magic of DCA. It takes emotion out of the equation. No fear, no greed, just discipline. And here's something powerful. Even if you had started DCA into the STI ETF during market highs in the past, you would still have come out ahead if you stayed invested for 5 to 10 years. Because what matters most is not timing the market, it's time in the market. So whether you're investing $200, $500, or $1,000 a month, focus on building your cash flow engine, one unit at a time. Let those dividends compound quietly, and you'll be amazed at how fast small steps turn into big results. Chapter 8. How the Fed rate cut could affect the STI ETF. Now, many of you are asking, what happens when the U.S. Federal Reserve starts cutting interest rates? The short answer? It's likely to bring a new wave of opportunity for Singapore investors. Here's why. First, cheaper borrowing costs. When rates go down, Singapore REITs, property developers and companies with loans pay less interest. That means higher profits and potentially more generous dividends. Second, stronger demand for dividend stocks. As global interest rates fall, the juicy 4% yield from the STI ETF suddenly looks even more attractive compared to fixed deposits or bonds. Third, bank earnings might moderate. Yes, lower rates could slightly squeeze bank margins. But historically, Singapore's banks adapt fast. They gain from higher loan demand and better credit growth, balancing the short-term dip in interest income. So overall, a rate cut is usually positive for long-term income investors. It pushes more money back into dividend assets, REITs, and stable blue-chip counters. Exactly the kind of companies the STI ETF holds. In short, if you're building wealth through dividends, a gentler rate environment could be your tailwind, not your headwind. It's not about predicting the next Fed meeting. It's about preparing your portfolio so that no matter what the Fed does, your cash flow keeps flowing. Chapter 9. Answering Mike's question, the educational way. So Mike asked a question that many Singaporeans are thinking about right now. Is it still a good time to DCA into the STI ETF at this all-time high price? I've already accumulated 11 lots. Mike, thanks for sharing that, because it's a great learning moment for everyone watching today. Now, I'm not here to tell anyone what they should or shouldn't buy. This channel doesn't provide financial advice or recommendations. But what I can do is help all of us think more clearly about how long-term investors might analyze and approach situations like this. Here are a few reflections worth considering. First, valuation context. At around $4.47, the STI ETF's price-to-earnings ratio of 13.7 and price-to-book of 1.46 suggest it's roughly sitting in its long-term fair value zone. Understanding valuation helps investors manage expectations rather than react emotionally to headlines. Next, cash flow focus. The ETF's dividend yield of about 4% highlights that many investors see it as a cash flow generating tool rather than a short-term trading idea. Then, DCA as a discipline. Dollar cost averaging isn't about predicting tops or bottoms. It's about removing emotion and staying consistent. It's a way to spread entry points over time instead of trying to time the market perfectly. And finally, mindset over timing. Some investors find it useful to focus on their own goals, risk tolerance, and time horizon instead of price levels alone. So instead of asking, "Is now the right time to buy?" it might be more meaningful to ask, "What's my plan? And am I comfortable continuing it through both market highs and market lows?" That's the mindset that tends to build confidence over time. This video is here to encourage that kind of independent thinking, helping every Singaporean make informed, thoughtful decisions after doing your own research or consulting a licensed financial advisor. Final thoughts. Let's wrap up with this thought. The STI ETF, also known as ES3, has been around for more than 2 decades, quietly rewarding disciplined investors with dividends and stability. It's built on the pillars of Singapore's economy: our banks, REITs, telcos, and industrial giants, companies many of us interact with every single day. Whether you're just starting out or already holding several lots like Mike, the key isn't predicting next month's price. It's understanding your own strategy and staying consistent with it. Because over time, consistency, patience, and reinvested dividends often do far more than any single market prediction ever could. So if today's video helped you think differently about long-term investing, please like this video so more Singaporeans can learn to be cash flow rich, not paper rich. And don't forget to subscribe to Wealth for You for more videos on dividend investing, CPF strategies, and practical ways to build sustainable wealth. Together, let's keep learning, keep growing, and keep building the financial future we all deserve.